Welcome back to Nexus Tech. If you're trying to make sense of the crypto market in late 2025, it feels like you're watching two completely different movies at the same time. In one, you've got this incredible story of foundational technology and massive institutional bridges being built at a truly breakneck pace. But then, on the other screen, you've got these catastrophic failures and staggering losses that remind you just how wild this frontier still is. So today, let's dive into this tale of two markets. And this is really the heart of it all, right? On one hand, you have absolutely mind-blowing growth. The Bitcoin Lightning Network's public capacity, it's exploded by 384% since 2020. That's incredible. But on the other hand, you have this chilling statistic. Hackers, many linked to North Korea, have already managed to steal over $2 billion just this year. Innovation and risk living side by side. All right, so here's our game plan. First, we're going to look at that incredible innovation engine that's pushing everything forward. Then, we'll have to face that shadow of risk that seems to follow it everywhere. After that, we'll dig into the global regulatory response, the attempt to build some much-needed guardrails. And finally, we'll try to chart the path forward. Okay, let's kick things off with the good news. Because underneath all the noise and the crazy market swings, engineers are quietly laying the groundwork for a future that's way more scalable and integrated. And a huge piece of that puzzle is Ethereum's Fusaka upgrade, which just went live. Now, this isn't about some flashy new feature for users. Think of it more like a deep infrastructural overhaul, like upgrading the entire electrical grid of a city. It's all about making the whole network way more efficient and robust for the future. The secret sauce making this happen is something called PeerDAS. Now, stay with me here. In the simplest terms, it's just a really clever new way for the computers running the network to check data without having to download every single piece of it. It's a shortcut that massively reduces the strain on the entire system. So what's the result? What does this actually mean? Well, PeerDAS is expected to give Layer 2 solutions, the scaling platforms built right on top of Ethereum, an 8-fold increase in their data capacity. For you, the user, that translates directly to cheaper and faster transactions on protocols like Arbitrum and Optimism. It's a huge deal. And hey, this isn't just an Ethereum story. Bitcoin's Lightning Network is really hitting its stride. We're talking a public capacity that's now over 5,000 Bitcoin, and transaction volume is up a whopping 266% year over year. And the big players are noticing. Block is integrating it, which could bring millions of merchants online. Plus, and this is a big one, you can now send USDT stablecoins over Lightning, which helps tackle that classic volatility problem. But maybe the biggest bridge being built between old finance and new finance is this. The Swift and Chainlink integration is officially live. The process is actually pretty straightforward. Any of the 11,000 banks on the Swift network sends a message like they always do. Chainlink then acts like a universal translator, converting it for the blockchain. And boom, a secure on-chain action gets executed. This is literally the blueprint for how tokenized assets could one day flow through the entire global financial system. Okay, but for all of that amazing progress, there's this dark shadow that just looms over everything. It feels like for every single step forward in the tech, some new risk emerges, and honestly, the stakes have never been higher. Just take a look at this number, $128 million. That is the staggering amount that was stolen just recently from the DeFi protocol balancer. It was one of the biggest and most painful hacks of the year. And the way this attack happened is just fascinating. The vulnerability wasn't some massive, obvious flaw. No, it was a tiny, almost invisible rounding error in the code. The attacker then chained hundreds and hundreds of swaps together, basically accumulating those microscopic errors until they snowballed into millions of dollars. And get this, the attacker's code had hints that it was probably generated by an AI, a weird phenomenon some are now calling vibe coding. Just wild. The fallout from events like this is just massive. I mean, look at this chart of the total value locked in DeFi. After it peaked at $172 billion, it plunged by $36 billion in just 1 month. That is a brutal reminder of how fragile this market can still be. And that fragility is now extending to the one place you really don't want to see it, stablecoins. This timeline shows two major depegs that happened in quick succession. First, Ethena's USDE briefly lost 34% of its value. Then, just a few weeks later, USDX crashed by a staggering 80% after its founder was suspected of having ties to that balancer hack. Not good.
So, this toxic mix of groundbreaking potential and truly catastrophic risk has, you guessed it, forced governments and regulators all over the world to finally act. They are scrambling to build some guardrails for an industry that is moving at absolute light speed.
And here you can see how the two big economic blocks are tackling the problem from slightly different angles. Over in the US, the pending Genius Act is super strict. It demands stablecoins be backed 100% by cash and only issued by FDIC-eligible banks. The EU's MiCA regulation, which is already up and running, also requires full reserves, but focuses a bit more on authorizing and supervising the issuers themselves. It's really two different paths trying to get to the same destination: stability.
And make no mistake, the ambition here is huge. This quote from the SEC's Project Crypto initiative lays it out plain as day. The goal isn't to crush crypto. The goal is to create a framework that allows America's existing financial markets to actually migrate onto blockchain technology. And to hit that goal, the SEC has a packed agenda. I mean, they're looking at a full top-to-bottom rewrite of the rules, modernizing everything from how digital assets are sold to redefining what a dealer even is in the crypto age, and crucially, updating custody rules for this new tech. And one of the most significant recent developments actually came from a place you might not expect: the IRS. They've just issued guidance that officially gives the green light for ETFs to stake the crypto they hold. This is a game changer. It opens the door for a whole new class of regulated investment products that can generate yield for investors, and we're expecting to see those hit the market by mid-2026. Look, this space is evolving every single day, practically every hour. To make sure you do not miss any critical updates on the tech, the risks, and the regulations, do yourself a favor and be sure to subscribe to the Nexus Tech channel. So where does all this leave us? Well, the path forward for crypto, at least for the foreseeable future, is all about navigating this constant, intense tension between explosive growth on one side and existential risk on the other. This chart really captures the current state of play perfectly. The industry's focus is finally shifting to real, hardcore infrastructure like Fusaga. We're seeing real, tangible institutional adoption with things like the SWIFT partnership. But at the exact same time, those persistent security risks are a constant threat, all while regulators are slowly but surely working towards providing more clarity. These are the competing forces that define the crypto industry as it matures today. Which brings us to our final question, the one that's on everyone's mind. In an ecosystem that's designed to be permissionless and is evolving this fast, is a perfect balance between innovation and security even possible? Or is this industry just forever going to be defined by its dance on the very edge of genius and chaos? That's the question we'll all be watching as we head into 2026. Thanks for watching.